Hey, welcome back. So, before we begin our video on personal finance, I wanted to make a few things clear. So, financial advice is something that needs to be a need based, individualist approach. So, anything that suits one person may not suit the other. So, for that same reason, any advice you find online from me or from anyone else may not suit your profile in every which way. So you need to do your independent research, your independent need based analysis to understand what is suitable to you. As I have done the same thing for myself, I have a few learnings which I would want to share, and through these videos and through the channel, that is what I will do. To put things into context, I think it is similar to what we have in terms of health. So anyone who recommends you have milk to have stronger bones may not necessarily know if you are a lactose intolerant person. So that is something that you have to evaluate at your end and then decide if milk is suitable for you. Same is the concept for finance and financial advice. I hope you understand my point, and I hope you get to learn a few things as well. Welcome back everyone. This is our channel Fun Way Runway, and I am Rahul. In today's video, I was going to talk up the topic of personal finance. But before we delve into what personal finance is and why we should focus on that, I think one thing I'm still pretty confused about is why is it not taught in our schools? मतलब हम बचपन से we see different kinds of subjects that have been taught across schools. We have learned science, languages, we've learned mathematics, etc. But why are we not taught about personal finance? I think that is one of the most crucial things a child can learn, and unfortunately most of the schools, if not all, do not teach that subject. Pretty strange considering even families do not really want to involve their kids in their grooming of finance related topics. Children do not know what kind of finances their parents are managing and what loans are, what investments are, how do you manage your own money. Now, these things are something that a child should learn when he or she is very young. I think if that can be done, when the child grows up, it will find such things easier to manage rather than being able to learn about these things when they are in their 20s or 30s even. I think it is something that the child should learn pretty much when they are in their teenage years. Personal finance, irrespective of your education, is something that you should learn about. And on this video, we will cover the pillars of personal finance. There are 4 to 5 critical pillars that personal finance stands on, and I think I will just touch upon each of those as we progress on this video. But if you want us to delve deeper into each of those pillars, I think we can create a separate video, and we may have plans to do so either way in the future as well. But for today, what we'll do is we'll take up each of those pillars and we will touch upon what exactly is it. So without any further ado, let's move to pillar number 1. The first and foremost thing that you need to do if you are in your 20s, 30s, or you just started earning, or even if you are in a later stage of your life, is have an emergency fund. Now, an emergency fund is like a piggy bank. आप कह सकते हैं एक मटका जिसमें आप एक एक रुपया डालते जाते हैं, एंड ये मटका सिर्फ तभी आप तोड़ सकते हैं जब आपको कोई और साधन ना हो पैसे कमाने की, एंड यू नीड दैट मनी. सो emergency fund is like that matka or that piggy bank that you have and you should have, and not everyone does it. I mean, people do not think that having an emergency fund is something that they will require personally. हो सकता है किसी और को ज़रूरत पड़े and they may need that emergency fund, but yeah, for मेरे लिए I'm very good with my finances. I think I'm very sorted. I won't need an emergency fund. Now this line of thinking is very wrong. I think everybody needs to have an emergency fund. It can be something on the lines of 3 to 6 months of your monthly expenses. Now when I say monthly expenses, your total outgo for the month on an average. Multiply that by 3 or 6 depending on how conservative your approach is. You can decide what your emergency fund corpus should be. And when you're living in a family, what you should have in place is a collective emergency fund that should equal 3 times or 6 times, anywhere between that, of the total outgo for all of the members in the family. Now, this amount is not to be touched under any other circumstances apart from an emergency. So what do you do? How do you keep that money safe? There are multiple ways you can do that. You can keep it in a simple savings bank account. Now, that is the most safest bet that you can do, where your money can be easily accessible. You can withdraw it easily if there's an emergency, or you can even have confidence on the money not being dissolved or the money not being lost anywhere. But there are other options as well which I think you should consider. One of them is a liquid fund. Now, a liquid fund is kind of an investment or into basically loans or debts, and it is a relatively safer bet. I would say it is a much safer bet compared to any other instrument, because liquid funds invest in bonds which are very short duration and are backed by the government in majority of the cases. So it is a pretty safe instrument. If you want me to highlight more of the features of a liquid fund, please share your views, and I think we will elaborate about it on future videos. So liquid fund is one, and a slightly more riskier option is a short-term bond or an ultra short-term bond. Now, these are relatively higher duration bonds, and thus the risk is a bit higher. But as we move further in risk, I mean from savings account to liquid fund to ultra short term bond to short term bond, the risk slightly increases, but so does the reward. As a safe bet, I think a liquid fund is almost as safe as a savings bank account in terms of the risk profile, but it gives you a slightly better return, and that is the reason I do recommend a liquid fund. Also, you can withdraw it almost in a day, and that is very important in terms of having that liquidity on your funds in case there is an emergency. So that is about liquid funds. Number 2 is your insurance. Now, everyone needs to have insurance no matter how much they make in a year. You can be rich or you can be not so rich, but insurance is something you should have. A term insurance is what most, or not, if not all of us need. A term insurance is basically a plain vanilla life insurance plan, and that too, it needs to be bought online. That is my recommendation. Now, when you think of insurance, don't think of it as investment and an insurance kind of a stuff. So ऐसे आप मत सोचना कि अगर मैंने चलो टर्म इंश्योरेंस में 10,000 डाल दिया, if I do not die, I do not get back anything. That is exactly how an insurance is supposed to work, and that is exactly how your car or your motor insurance works. If there is no accident, you don't get any money back, and life insurance needs to be on similar lines. So that is why I recommend no other insurance plan but a simple online term insurance. Now, which term insurance you should take up, that is up to you. There are a host of insurance products in the market, insurance companies. You can go and check out each of their products. You can check what their claim settlement ratios are, which is basically if there are 100 claims, how many do they settle, and you can make your own call. So that is term insurance. The other insurance that you should have is the health insurance. Now, in the times of COVID, it would have been a big burden on anyone to have to pay out of their own pocket sums which they are not really comfortable with, and especially for those who do not even have an emergency fund. So in such cases, a health insurance plays a critical role. The health insurance should ideally cover all of your existing illnesses as well as any probable future illness. So that is something you need to check and you need to go through. But make sure that you have a health insurance plan that is very robust and it covers most of your expenses. You can check if you want to go for part payment, or you can check if there is an option for the entire payment to be made by the insurance provider. So health insurance is the other insurance that you should have no matter what. And these two are the primary insurances. Of course, there are other insurances like car, motor insurance, or even house insurance. So those are something that come later, but term insurance plan and health insurance plan are the two most important insurance plans you should have. The third pillar is, where do you invest your money? So of course everyone has some amount of savings and everyone has a different risk appetite. So based on what your risk appetite is, you should ideally invest the excess money that you have in instruments that will help your money grow, will help your money make more money. So I personally prefer the 120 rule. I'll tell you what that is about. But there is also a 100 rule. So what it is basically how you should distribute your investments. So what the 120 rule is, whatever your age is as on date, your investments should be split in that breakup. So suppose your age is 30 years. So what you do is 120 minus 30, that is 90% of your investment should be in equity, and the remaining can be in safer instruments. You can probably divide it between having some amount in debt, say 30% in debt and 20% in savings account, or you can even decide to have say 2 or 3% in gold and the remaining in savings account. So these are the different buckets that you should invest in based on the 120 rule. So again, to repeat, 120 minus your age is the percentage of your investment that should be in equities. Equities could be stocks, funds, mutual funds, any other products that are into equity, wherein you buy a share or you are a shareholder of that or company or the entire stock market. My personal recommendation is, if you're going to invest in equity, it is better you invest in an index or an ETF. So index and ETF funds are basically a distributed kind of an investment. They do not invest in one particular stock, they invest in a buffet of stocks or a buffet of different companies. So over the past decade or so, in India and across the world, it has been observed that in very rare cases are the fund managers able to perform better than the index itself. So when I talk about index, I talk about the Sensex, I talk about the Nifty, the Nasdaq, the Dow Jones, the Russell index. So these are indexes that each of those stock markets have, and when we invest in an index fund, we invest in the entire. If it is a whole stock market index fund, we invest in the entire index, that is all of the stocks that are on that index. And as I said before, in many cases across the world, the index has been growing at a faster rate as compared to an investment fund manager who is investing in any set of stocks. So if you are not very savvy with financial instruments, or you do not understand it so well, I think the best bet would be to invest in an index or an ETF. Now, what an index and an ETF is, we can maybe cover it in another topic, or I will also give you a link to some of the videos that are already available on the same topic. So do make your own research and do invest your excess money so that your money keeps growing if you have to beat the inflation that is around us. Now, what inflation is basically, a packet of bread costs say 100 in whichever currency you prefer, and after 10 years the same packet of bread would not cost you 100, it may cost you 1000. So the movement from 100 to 1000 for the same packet of bread over a span of 10 years is primarily because of the inflation. The final pillar in all of this is to have a clear understanding of your finances. So there are some basic rules that you should follow when you plan your finances. First, you should be well aware of how much expenses do you incur every month. I personally have this app that I use, Andrew Money, in which I document every expense that I incur, be it an ice cream or be it a down payment for my home. So every expense that I incur is captured in that. Over a span of years, you get a very good idea about what your expenses look like, what kind of expenses you do not need. in your life, and you can accordingly plan, and you can optimize your total expense outgo, and thus you can optimize the amount of money you keep with yourself or you save with yourself. Now, to have more money with you, you cannot really depend on one income source. In today's days, one income source is kind of a risky proposition. If for any reason you happen to lose that income source, you will not have any other income coming to you, and thus you should need to have at least 2 or 3 income sources. Now, the richest people in the world ideally have 7 or 8 income sources, but my recommendation would be you start with at least creating another income source along with your primary income. It could be your salary, it could be rental income, it could be investments in stocks, it could be investments in index funds, mutual funds, etc. It could be anything. So try and create new revenue or income generating ideas or opportunities. So these are the 4 main pillars to have a quick refresh. The first is the emergency fund, which everyone should have. It is like a small piggy bank that everyone should have, only broken when they have no other option. The second is insurance. Within insurance, there are 2 items that I mentioned. One is your life insurance, the term life insurance policy, and the second is the health insurance. So these are the 2 major insurances that you should have. And third is your investment. Now remember the 100 rule or 120 rule. Based on your risk appetite, your risk profile, you can actually allocate your funds in the correct proportion. As you age, your proportion of risk reduces, and thus you can increase the investments in debt instruments or saving instruments and reduce your exposure to high risk instruments like equity. So that was the third one. And the fourth one is how you manage your money. How you manage your money, as I said before, you need to have a clear picture of how your expenses are going out every month, and you need to then figure out which expenses are unnecessary. And the other part of the same coin is that you need to create multiple income sources, not depend on an only income source. So these were my tips, suggestions, and a broad overview of what personal finance should be. I understand this may be a complex topic to teach someone in school or even in their teenage years. Probably they may not be interested in such topics, but I think there are examples or there are ways we can teach young people what personal finance is. So I would like to think of an example of a terrarium. So you know what a terrarium is. It is a small world or a small glass box which has its own internal climate, internal atmosphere, microbes, etc. I will share a link on what terrarium is. And all of the flora and fauna within that terrarium is not exposed to the outside world, and you as an observer can control that world. So that is something I think should be the way how we can teach youngsters, and we may create instances where how they can manage their pocket money better, how they can increase their pocket money by their own efforts. So there are ways we can do that can help children and teenagers to incorporate some knowledge or incorporate some responsibility on how to manage their investments when they grow up. So this covers our main agenda for the day. Thank you for coming on board and viewing our video. I hope to see you soon again. Our next video will be coming up next week, and we will delve a bit more deeper into the topic of personal finance. Till then, goodbye and see you soon.